topic of the lower of cost and the net realizable value is based on the fact that when you're in business and we have inventory, it costs one price and we always try and sell it for more than that price to make a profit. And this topic's about, well, what if that's not possible? So let's just take a really basic example and say, well, in 2007, a retailer purchased 10,000 iPods thinking they could be easily sold for the next 20 years. The iPods cost the retailer $250 each. Now, at the time in 2007, the iPod was the most popular electronic device that Apple sold because there was no smartphone. And what the problem with this is, the retailer didn't anticipate that later in 2007, the iPhone comes out and that makes the iPod obsolete. And today the retailer has 1,000 of these iPods left, and they estimate that they can only be sold for $50 each. So in the real world, there will actually be businesses that do have iPods left over. They're still around. The thing is, you're not going to be able to sell them for more than they cost though. And that's what this topic's about. How should we actually value these iPods then? Should we pick the cost of the inventory from 2007, which was $250? Or should we pick the current selling price of $50? That says $150, it should say 50. The problem here is the accounting theory says different things. If we look at relevance, verifiability, faithful representation, or accrual basis, you could argue and use those to actually justify either of those selling prices. So what we need is a rule. And what we're going to do is, sometimes a business, we're going to recognize that things go below its cost, its value, but maybe it's not because it's an iPod from 2007. What are some other reasons why an inventory might get sold for less than its cost? Well, the first example was the iPod. The unit of inventory has been superseded by a newer model, e.g. an iPhone, but also an older, an iPod, but also an older iPhone. So there'll be businesses with iPhone 10s still left in stock, and you can't sell those for more than they cost because there's newer iPhones out there that make it difficult to sell them. We could also have products that are obsolete, for example, typewriters, CDs, or analog TVs. Those will exist out there in warehouses somewhere, and you're just not going to be able to sell them for more than they cost. Some products are perfectly fine, they're just out of season. For example, we might be trying to shift umbrellas in the middle of summer or swimwear in the middle of winter, so we need to lower the cost. Sometimes they're out of fashion, they're the wrong color for the season, or just to use a sports merchandise example, the jersey here is for LeBron James at Miami. He doesn't play there anymore. So sometimes we might need to lower the cost or the selling price of that inventory for less than its cost because we can't sell these jerseys because they're out of fashion. Sometimes inventory is damaged or spoiled but can still be sold. For example, bread, fruit, vegetables, so anything to eat that's maybe just past its use by date or on the day of the use by date, you'll often see the price of that is reduced. And just an example is cars with hail damage. Often cars on the lot get damaged during a hailstorm. And that's very difficult for the car maker to then have to go and fix all those with a panel beater. So they just say, let's write them off and sell them for whatever we can, and the people that buy them can get them fixed. So there's still nothing wrong with them. They're just damaged or spoiled, but they can still be sold. Some businesses make their whole business model at selling things deliberately below cost, e.g. lastminute.com. They get hotel rooms from hotels that are available tonight, and the hotel says we'd rather get something for that room rather than have it empty, so it's sold deliberately below cost. A lot of concerts for tickets would operate using the same principle. The point being, for things like this, we need a rule. How are we going to value the inventory in this case? So in our subject, we're going to say the rule for inventory valuation is inventory should always be valued at the lower of the cost. And when we say cost, we mean the product cost. That product cost we used in the previous topic. We'll come back to that in a second. Or the net realizable value, which is a new term that we're going to have to look at. What's the definition? Let's start with product cost, and we're going to say whichever one of these two is lower, that is the value we're going to use for inventory. Just to go back to cost, we said, well, the cost of inventory is always its product cost. What did that mean? That was part of cost of goods sold. A product cost is any cost or expense incurred in getting inventory into a condition and location ready for sale, and it can be allocated to individual units of inventory on a logical basis. That, when we say cost from now on, we mean product cost. So just to use an example from a previous lesson, on January the 1st, a furniture retailer purchased 10 units of these couches and we're going to sell them for 500. But it had all these costs. There was a supplier's price for 10 units, that was $180 each. There was delivery inwards of $200 for 10 units. There was customs duty to import the couches from overseas, which was $200 per annum or year. There was the marketing of the couches for $300 and delivery costs incurred to the customer, which was $500 for 10 units. And what we learned was that we divide all these costs into two groups. One is the cost of goods sold. That will be all costs or expenses incurred in getting inventory into a condition and location ready for sale. On the other hand, we'll have the other expenses, which are expenses incurred in running the business on a daily basis and or getting inventory from the business to the customer. And we also learned that when within the cost of goods sold section, there's product costs. They're the ones that can be allocated to individual units on a logical basis. And there's period costs. They're the ones that can't be allocated to individual units on a logical basis. So if we just look at the couch, what would its product cost be? We start with the supplier's price of 10 units. Well, that's clearly required to get it in a condition and location ready for sale, and it can be allocated to each unit logically. We've got the delivery inwards. That was $200 for 10 units. That is definitely required to get inventory in a condition and location ready for sale. We can't sell it unless it's been delivered to us. And it's $200 for 10 units, so pretty logically we can allocate that at $20 per unit. Customs duty is definitely required to get inventory in a condition and location ready for sale. The problem here is this charge of $200 is per year, and we don't know, did we buy couches in other months, how many did we buy, and so forth. So we just can't logically allocate that one to each unit, so we're going to put that in as a period cost. Marketing of couches are not required to get inventory in a condition and location ready for sale, so they'll go over here in other expenses. And lastly, delivery costs incurred to the customer. Now they can be allocated to each unit logically. It says $500 for 10 units, so that's kind of this here. The problem is they're not required to get inventory ready for sale. These would be incurred after we've sold the inventory. So therefore that would be another expense. The whole point here is we're going to have a product cost in this case of $200, and that is going to be the figure that we refer to as cost from now on. But then we have the net realizable value, which is our new topic for this lesson. What does that mean? What we say is the NRV is the estimated selling price of inventory minus any selling, marketing, and distribution costs. And that can be sort of looking at it, go, is it cost of goods sold? Is it other expenses? You actually want to treat this completely separate at that topic and just take this very literal and go, the net realizable value will be the selling price less any costs to sell, market, or distribute the inventory. Don't worry about whether it's a cost of goods sold, other expense, and so forth. We're just looking for selling, marketing, distribution costs. Let's just take a basic example. When should we value inventory at the lower of cost or net realizable value? Let's pretend it's December, the start of summer, and we have 100 winter coats left in inventory. Well, if we don't sell them now, we're going to have to hold on to them in our warehouse until winter. We don't want to do that. The cost of these is actually $50 each. That's the product cost. But we want to get rid of them now because it's summer, not winter. We want to use the shelf space for something more, something we can sell more of than winter coats. So what we're going to do is in summer, we're going to lower the selling price to $40. But to also move them, we're going to take out an ad for $200 out on Facebook saying, here's these winter coats, come get them right now today. And that ad is for all 100 coats, and that costs us $200. So how should the coats be valued in the balance sheet? Well, we say we'll take the lower out of the cost, which is the product cost, or the net realizable value. And applying that concept here, we were told the product cost here is 50, so that's what we say is its cost. In terms of the net realizable value, we're looking for the estimated selling price minus any selling, marketing, and distribution costs. So we were told the selling price is now $40. But then we've got to take out any cost to get rid of this inventory to sell, market, and distribute it. And we've got a $200 ad on Facebook for 100 coats. So that works out at $2 per coat. In other words, 40 less 2 is 38. And this topic is all about recognizing, well, in this case, we are valuing this inventory at the lower of its cost or net realizable value. So at the moment they're valued at 50 because that's when we bought them. They're sitting there. But we need to get it down to this figure here, this $38. And to do that, we're going to say that's something called an inventory write-down of $12 per unit. So in the next video, we're going to learn what is this inventory write-down and how will we process it.